Hey folks, thought I'd pop in here a little bit early, see if anybody had any questions before we get started here. Otherwise, I'll just hang out for about a minute here until we get started. Let some people start funneling in here. All right. Thought I'd pop in here a little bit earlier, folks, just make sure everybody is in and ready to go when we get time. A couple seconds early here, but we'll get started. I just want to make sure everything was working properly so I don't make a mistake like I did last week. All right. I think it's 1:15 now. No, very close. Couple seconds here and we'll get started on this. Just want to make sure that we start on time. And hey, folks, feel free to comment throughout the video over in the comments section. I'll make sure you guys are clear of concept before we get going. All right, so let's get started. Hey, folks, thanks for joining us today. My name is Eric Wilkinson. This is with Pro Trader Strategies. We're an educational company, folks. So what we're trying to do here is teach you a little bit about the markets, how to do some swing trades by those setups we'll find in the technical analysis. And ultimately, what I want you guys to come away with is how to trade options in and around these assumptions we come up with. And why do I like options more than something else? Well, because my probabilities of success are so much better. So why trade something where you got a coin toss 50-50 versus trading something with options when you can completely turn those probabilities in your favor? And that's what we like to talk about here at Pro Trader Strategies. So if you want to find out a little bit more about that, make sure you guys, before you leave, hit that subscribe button. Also, you can click on something there, folks, that gives you a heads up when I'm coming live, because I do have scheduled videos like this, the webinars on Thursdays, but I also will pop in throughout the day trading and talk about a trade that I might find. So make sure you got those notifications on so that you guys will make sure, we make sure that you guys get to see those. How you doing, John? Good to see you. All right, and finally, smash that like button for us, folks. It does help us out. So without further ado, let's get on with the webinar here. Like I said, we are going to be talking about swing trades and ultimately how to implement an option strategy around that swing trade. So you get kind of two for today. And these are on the bearish moves. We've already talked about our bullish moves. Now we're talking about some pullbacks here in this webinar. And then the next section that we're going to be starting next week is going to be on neutral moves where the market's trading sideways. So if you want to learn out how to take advantage of a sideways move, check those out there. All right, so we're going to build from simple concepts to real life examples throughout this video. And without further ado, let's get on with it. This video, we're specifically going to be talking about the long put diagonal with these swing trades. So we need a bearish assumption to come up with anyway, or when you have a bearish assumption and all of the levers and pulleys start working out in your favor, this could be the strategy to put on. We'll talk about the long call calendar. Remember the put calendar we did last week. That's working out with all these levers and pulleys I talked about, despite the fact that I'm directionally wrong. That trade is still working out quite nicely. And we'll talk about how that trade being directionally wrong is still making money. We could have done the long put diagonal with that trade as well. And I'll talk about all those details towards the end here. But first, let's talk about how do you do what is a swing trade? Really, a swing trade is basically trying to find the market shift, okay? If the market is selling off, you're trying to spot that time when the market turns bullish, all right? So ultimately, to do that, you need to start out with what the overall underlying, your XYZ stock, ETF, or whatever you're trading, it could be even a future, is what type of overall direction is it going in? This would be bullish, right? If you saw a market trending this way, that's a bull trend. We've got market neutral and then a bear, right? So then a bear trend. If it's overall, you kind of squint your eyes, you can see the underlying's falling out of bed, right? Well, then what we want to do is look at the overall market and see how it is doing and what's going on there, right? Even if it's a neutral assumption kind of thing, all right? Or a bear, we could even say. Then the next thing, now we've gotten this overall direction down. we want to look for resistance where the underlying loses its momentum to the upside, and you will find that it will have a tendency to follow along some of these trend channels. And you can squint your eyes. It doesn't have to be exact, folks. It's not an exact science, despite the fact that there's all these technicians out there that tell you it may or very well may be, or that they're 100% correct. That's not the case, folks. We're just trying to increase our probabilities of success with this. So we've got our support and resistance. We've got, resistance here and support. You're trying to find where that support is, where it's hitting the most times. It will break through there every once in a while. Resistance, support, okay? So we've got our overall trend. That's the first thing we want to do, is figure out if it's bull, market neutral, or bearish. The next thing we do is kind of look for those support resistances. Where does this underlying lose its momentum or gain support, right? And then we're going to base our trade right here on the swing or the pattern change, okay? So ultimately, we've got a bullish trend. We found our support and resistance. Now we've got a bullish pattern within that trend. That's what we're looking for. I didn't do a very good job on this one, but let's just say we've got a market neutral with a bullish trend going on there. And obviously with all of these, I did a bullish trend inside of, a bullish pattern inside of all of these trends. We've got a bear trend with a bullish pattern. So we're basing our trades on the pattern, not the overall trend, but the pattern within that trend. That's the key. So when we're looking at something like this is an old example of IBM, but you can kind of just draw the lines like this, and you can resistance. You can see support. Yes, it does break through every now and again. It will happen. But if you're trading this as a long and a short for this underlying, you're beholden to the market move. Now, in a situation with the options, we can get better strike location. I'm going to show you how to get better strike location today with this trade that we're going to be talking about with the long put diagonal. But here, I would say that this would be, it's sideways trend with a bearish pattern setting up, all right? So when we're looking for, somebody mentioned this after one of the last webinars on some of the candlesticks that I'm looking for, like why is this one a topping pattern versus something else? So just with candlestick theory, the real thing to look at, and this is from a very remedial standpoint, the key candles to look for at a top of a move or at a bottom of a move, all right? Not inside of a move, folks. At the top of a move, at the bottom of a move. You're going to see these two right there are, can you see those right there, everybody? There's a couple of them inside that sideways move. That's not going to be what we're looking for. We need them in the broader sense. So you're looking for candles like this. This is a hammered doji, hangman doji, all right, where it's at the top, okay. Spinning top. Sorry, should be a block, so where it's just got a little bit of the wick there. Now, all of these can be either green or red at the move. And I'm not just lining these up. Those are the key ones that you're looking for, whether or not they're red, all right, or, this way, okay. So I know I'm getting a little messy there, but you guys get my point here, that even though the candle is red or green, that's what we're looking for in a move at the top, okay? This could have been a green candle at the top, kind of, instead of doing that, looking like this at the top of a move, and that would have been something we would have looked for, okay, on that. And it could have even been a green candle, to be honest, if it was like this at the top of that move, okay? So any of those types of candles at the top of that move would have been something that would have sparked my interest in showing the momentum is starting to slow there, okay? So with that, that's what we're looking for on a swing trade, those types of candlesticks setups, especially that's for, if you have a higher risk tolerance, that's what I look for. I usually will base my trade on those setup candles. But normally what one would say is on something like this, you get a candle at the top of a move like that, wait for confirmation. This would be a confirmation. Any red candle basically closing below the previous day's low there. That is a confirmation. Or even if this candle was engulfing that candle, okay? So that is a very bearish sign too at the top of a move. And we saw that in NVIDIA. That's the reason why I brought that example in there. You can see something like this where this is actually a high, an open high or a newer high. That's still a very bearish candle engulfing that previous one. So those are the kinds of setups we're looking for with swing trades to especially for newer traders. There's other setups. There's all kinds of them. There's even the tombstone. If you see something like that at the top of a move, that's usually a pretty bearish signal. So you guys have got this, right? So far anyway. First, how do we swing trade? We identify that overall trend. Bullish, right? Is it overall bullish, market neutral, or bearish, right? Then you're going to look to find that support and resistance area. Remember, that's where we're kind of finding those dotted lines, right? Kind of, you can glaze your eyes. Somebody else reached out to me during one of the daily market commentaries and, or actually one of the spot the trades, and was asking about support and resistances and how I really like to look for those, whether it's Fibonacci or anything else. I said, one of the best ways really to do it is to kind of glaze your eyes and see, because Fibonacci and all that other stuff, don't get me on a tangent about that. I do use all of those, but at the end of the day, do the markets act like a conch shell? I don't know. Trevor, what do you got over there? Trevor said, you need to take some art classes or make the chart bigger. I might be able to make the chart. I could zoom in on the charts probably. I'll try to do that. And then finally, we're basing our trade on the pattern. Remember when we were looking at the pattern, we're looking for this, right? The pattern change on this, okay? The pattern change. That's what we're looking for to base our trade on, because that shows the momentum moving. What happens sometimes with swing trades? It's not an exact science, folks. It will break out up and above sometimes. But like I said, with options, you can be directionally wrong and still be making money. I'm going to show you that perfect example today with that calendar that we did last week. I've gotten the directionality. It's going against me now, folks, but that trade is making money because of all of the levers and pulleys are working in my favor, like we talked about in the video. We can't always be directionally right. We can set ourselves up for success by using chart analysis. Don't get me wrong. We can help ourselves there, but it's not an exact science. It doesn't always work. That's why we want to use options in order to shift that paradigm back into our favor there. So I got a little ahead of myself. Better probabilities, better odds. I'm just going to say better odds. You get better odds. And if you have better odds, right, you know what your probabilities are. If you know that you have basically an 80% chance of success, are you very nervous? You're kind of sitting back. It can kind of go against you a little bit, right? You're not too worried because you know the odds are in your favor. It will help you stay mechanical. If you have better probabilities and you know your probabilities, you will stay mechanical. You're not going to break down. You're not going to get emotional. And that's something I talk about all the time with trading. One of the things you have to remove that emotion. And one of the only ways to remove that emotion is to remove the thought that you are trading with money, right? Or that you can lose money, all right? What you need to do is shift that thinking to probabilities. The probabilities are in my favor. Yes, this trade is moving against me, but I still know my probabilities, all right? That will help you stay mechanical and keep your powder dry. You're not going to be trying to get in and out of this. When you are long and short and underlying, especially like futures, if you trade futures or even the ETF sometimes, that volatility, that movement creates bad habits because you start thinking about, I'm losing money. You're not thinking about the probabilities are in my favor, or I still have got about an 80% chance of success despite the fact that my trade is not looking good right now because it might be going against you or whatever reason. So options, the reason why I like to use them is because you can get better strike location, better odds. For instance, when this was breaking down below here, a lot of people were calling for it to come down and test around 410-ish area. But I talked about this. We've got these trend channels, and this is one of those things where there's no Fibonacci for this. I just kind of blurred my eyes and tried to hit as many tops and as many bottoms as I could on these lines. All right. And they followed through. As a matter of fact, these lines reach back all the way to 2017, 2019. And we've caught back up to that trend. Or sorry, no. Yes, 2018, 2019. During that trend, that was a nice bullish trend, and I threw that in there because at the time it was about a 45-degree angle, and it's continued with that. So we were able to get strike location well away from it. Market move, even though it broke below those areas of support, because my strike location is further away, rather than having a future that was dollar for dollar right then and there working against me, we were able to stay with this trade when it started peeling against us. All right, so I want to talk about a trade that I'm looking at today. So for instance, this is one of those lines in the sand where I just kind of drew in there where it was hitting a lot of tops there. So this isn't part of the Fibonacci, but it was something that I thought we needed to have in there. So it's not always the Fibonacci's I'm looking at necessarily. In this case, though, what we can see here is we've got a bit of resistance right there. We've got, a support level down here. That's going to be for some of the people that are a little less risk tolerant. If you have a higher risk tolerance, then you would probably be looking at around this line for that support, okay? Now for me, I believe we're coming down to that support I just drew in there at around 490. I think that the market, and all it has to do with Netflix's earnings. They came out and basically said that they're having trouble getting new subscribers, all of that. They aren't worried about, what was his quote? I wrote it down here for a second. I wanted to talk about not concerned about other content providers. If that's not a nail in your coffin, I don't know what is. They've already lost a lot of their content, a lot of the Marvel and some of those other ones to Disney, who have the rights to those. Disney has the content. I mean, I don't know how big Disney's library is, but it's got to be massive. They don't have to go out there and find new content. They've got it. It's in a warehouse somewhere. Whereas Netflix has got to always stay creative and stay ahead of the curve in a sense. So I think that Netflix has got a definite uphill battle here going forward over some of the other ones. Now, I'm not saying I want to go out there and buy Disney based on this. I just want to get long-term bearish in Netflix, maybe even heading into their next earnings when I think that they're still not going to do very well. So I'm basing this off of a breakdown below this Fibonacci, okay? There's not great setups here other than I've got a target breaking down. I'm kind of jumping in this trade partway through, but it was one of the better ones that I could find, and we've already had the earnings. So we're kind of in the middle of earnings season right now. It's a little bit more difficult to throw some of these trades on longer duration because I don't want to encompass that earnings trade necessarily. If you guys have been following me for a while now, you guys know I like to trade the earnings for that event, like that day for that event. So I don't want to get involved in a trade 5, 10 days, even 30 days out ahead of an earnings necessarily for a trade like this. So that's why I want to stay away from that. After the earnings, I think that we're going to see some follow through here to the downside. A little bit of a blip to the upside won't hurt me, just like we saw in the calendar. You kind of want a little bit of a blip almost against you in the beginning in order for that long-term trade to play out. Can you make the chat bigger? Is that over on the side or on the window there? Hey, Eric, is that a picture of the famous Larry Williams behind you? Oh, no, that's the coach. I got Ditka back there. And if you can see the little tiny picture of me, that's, I can't think of it. The little girl from ET is all I can think of. The chart is ever so small. Do I have it on the, oh, thank you. There we go. Is that better, guys? Sorry about that. One of the things about controlling, I meant to do that right off the bat, as a matter of fact. I set it up that way so that I wouldn't forget to share the screen. Is this a lot easier for you guys now? Trevor, I think we're on the same page. Thank Oleana. So we're going to look at a trade playing to the downside on this here. But if we're going to use options, let's just do, for some of you, it's going to be a little bit of a review. Some of you other ones, I think I've got some easy ways for you guys to remember these options if you're really new to trading. All right, so the option buyer, all right, that gives the option buyer the right, but the buyer has the right but not the obligation. Just remember that. The buyer has the right but not the obligation to fulfill this contract. The seller has the obligation. He has to go through with whatever we say, all right? Think of it that way. The call buyer has the right but not the obligation to buy the stock. So if we're looking at a stock, XYZ, let's just say, it doesn't matter what it is, and trading at $100. Simple example here is if you bought a call at the 105 strike, okay? You're buying a call at 105. That gives you the right but not the obligation to buy the stock at 105 because that's my strike. I bought the 105 strike. That means I have the right but not the obligation to buy the stock at that price. Now, when the stock is trading 100 and my call is 105, do I want to buy XYZ at 105 when it's trading 100? No, there's no real value in that. Now, if XYZ, I bought that 105 call and XYZ now starts trading higher and higher and higher. Now it's trading 150. My 105 calls, are they worth anything? Yes, I can buy XYZ at 105 when it's trading 150. There is an immense value in that. And options have to price that in. I have to be at least paid, if not more, than the distance between my strike and where the underlying is currently trading, all right, when they're in the money. If the underlying went down or stayed right here, those options would just expire worthless because there's no way I would pay higher than where it's currently trading, all right? I'd just go out there, let those options expire, buy the underlying in the open market, all right? Now, if you bought a put, well, actually, I'm going to get ahead of myself there. I want to talk about the call seller. The seller has the obligation to deliver that stock, meaning if I sell the call at 105, that means I am willing to sell my underlying at 105. Like, take it away from me at 105. I don't care. That's the way you got to think when you're selling options, especially the calls. You have to pick a strike where you're completely happy with getting short that underlying at that price or getting rid of your stock at that price, okay? So the seller has the obligation no matter what. The seller of the option at that 105 call, if I have a 105 call, I'm short, and the underlying's trading 100, and some goofball comes out and says, yeah, I'm going to exercise my right to buy that stock at 105, well, he can do that, all right? Those are good problems to have. You've all of a sudden selling the stock at 105 and it's trading 100. I can't say that that's ever happened, but I'm sure it's happened. It's never happened to me. I've never been that lucky. All right. So the put buyer has the right, but not the obligation to sell, right? The call buyer has that's easy, right? You call up, put down. All right, that's the way we used to teach people on the floor when you're doing ARB and stuff like that. Basically, you call up and you put down. All right, so puts go down, calls go up from the buyer's perspective. So a put buyer wants to sell the stock. So if I bought a put at 95, right, that means I'm willing to sell my stock at 95. And usually people are buying that as insurance, right? I don't want to sell it any worse than, all right? Problem with that is it also increases your cost basis on it. And I talk about that in some of the other webinars. I'm not going to really dig into that right now because it's not going to affect that. But now if this underlying went down to 75, those puts have immense value. And I have to be compensated for the distance between 95 and 75. So at least these premiums are going to be at least, if not more than that $20. It has to give me the intrinsic value, which is what it is actually worth, or the benefit of what it's worth. All right. And the seller has the obligation to basically take delivery, to buy it. If I sell you a put, I don't think it's going to go lower than that, and I would be more than happy to buy it. So when you are selling options, make sure you have good strike location. I have no problem with people selling naked short puts or even cash secured puts. I think that's a great way to dollar cost average. I would never say leave a GTC order in there at a location where you're willing to buy Apple at 100. You're not getting paid for taking that risk, folks. If you sold the 100 put, you would be getting paid for taking that risk in buying the underlying. Okay, so options, definitely a better strategy there too. All right. So now we've talked about these options. They all have different pricing. You've heard me talking about some of the different pricing in these: intrinsic value, extrinsic value. Extrinsic value, folks, is just basically time decay or theta decay. And the intrinsic value is what it's worth. So if I bought a 95 call and the underlying's trading 105, my put that I bought has to, no matter where I paid for it, if I bought it at 90, or if I bought the 95 put and it's trading 105, that put has to be worth $10, if not more. Okay. It can't be worth less than the difference there. Does that make sense? All right. So now that we have all the pricing, we have to determine whether these prices are cheap or are they expensive. So we go over the option montage. So if you ever hear me talking about the option montage, folks, it's this page. It's got the delta, the gamma, the theta, the vega. And this is the call side and the put side. All right. Calls and the puts. And they all have their data points there. So when I'm looking at the underlying, oops, I didn't want to hit that. I want to erase something. I want to erase this line here just because it's blocking my next move. So Vega is what we're going to be talking about, because Vega determines really what the pricing is. Yeah, a lot of people will say time determines it, like those premiums way out here in time are a lot more expensive than these in here. All right, you've got that. But that is going to constantly erode. Whereas with Vega, which is just implied volatility, folks, implied, I'm not going to write it all out, implied vol. All right, implied volatility. You'll see that show up in a lot of different places in the charts and even in the option montage. But Vega is just implied volatility. It's just a fancy name for it. I guess they had all these other Greek names and they were like, well, we can't just say volatility all of a sudden. Now we got to get fancy. So they named it something that wasn't even a Greek, which is Vega. So Vega determines these prices, because what happens with Vega is, you know, the rules with the Greeks here is it's all assumed to be moving forward or advancing, okay? So in Vega, the rule is for an increase in implied volatility, and it's 1 percentage point. For every 1 percentage point increase in volatility, our premiums will increase by that much. So we get a 1% increase over here. So now we're looking at 2809, right? So that 1% increase, that volatility goes into those, all right? And as volatility comes out, a negative move, then that becomes a negative move plus a positive Vega, it's a negative Vega. So as the underlying would move, or as the volatility goes down, all of the premiums go out. You can see Vega is positive across the board. So as volatility increases, all the premiums increase. As volatility decreases, all the premiums decrease, okay? So with that rule, that's logical, right? Up, down, right? So if this number is extremely high, then we know these premiums are high, right? And if this number is extremely low, we know that the premiums are extremely low. And we can't just look at it being 27. You guys might be saying, all right, well, I'm looking at Tesla right now and it's like 150, right? We're not comparing apples to apples, right? We need to compare apples to apples, which means we need to compare Netflix volatility with Netflix volatility, all right? We aren't comparing Netflix volatility to Tesla's volatility. We're It's got to be in and of itself. So what we want to do, I'm looking at Netflix. I look over there at the Vega. I need to see what 27 means to Netflix. So we can go over here to the chart and we can see down here we have implied volatility. All right, that's Vega. You can see here's that number 27 that we were just kind of looking at, right? That's this point on this chart. Oops, get away. That's this point on the chart. Okay, so you can see that the underlying is kind of like watching a swing trade without the candles. We can see that there's, resistance up here and support, at least here's the support recently. So, what I'm doing right now is discounting all of everything that happened last year. I want to get clean data for this year because our volatility has been all over the place. In the past, the current volatility, or VIX, is probably high compared to like 2016 or something. All right, but it's low compared to what we just went through. So there's a mixed bag there. Like that volatility was the highest we've seen since the 80s during the pandemic, to give you a little perspective. So what we want to do is look at this as a swing and kind of find the resistances and the supports and where it's currently at, because that will tell us within this range if we're near the high end or the low end, all right? And it doesn't mean it can't go a little bit lower. What we're trying to do is, get ourselves set up for success. If I were to come down here and sell options when they are that cheap, all volatility's got to do is start upticking and the underlying stays right where it's at, and I could lose money. So that's what we're trying to talk about here, to set you up for success. If you see premiums are cheap, don't be going out there to sell them and collecting a premium. All right. You want to be thinking about, I need to actually put up some money because it's really cheap right now. You want to buy low, sell high, buy low, right? The higher resolution, you know what it is? Some of these, what I had to do, I tried to do it for you there, John. I tried to blow it up so it gets a little blurred when I'm stretching these out for the platform. So like this one, I tried to stretch out a little bit to make it a little bit bigger. All right. So here is the chart zoomed in. So I basically am stripping out anything that happened in 2020 and moving it forward here. Some people might say that that's a bottom, but it's inside of the move. Remember, it's kind of inside of this trend. So I'm going to discount that as a support area. I think the market's going to start falling down. But with volatility here, we say that's the resistance, that's support, right? We are very near that bottom line, which means they're really cheap, right? At least the cheapest we've seen in the last 52 weeks almost, right? So here, let's zoom in even further on this to get a little bit better. So you can see I played around with this number thing to try and get it to get exact, and it wasn't working for me. So what we want to do is find this high. I'm going to call it 51. I'm going to call this low 25. And we can see we're currently right there at around 27. Another one of those boys where I stretch this out. So you can eyeball it. I have no problem with that. Get your eyeball around 50%. This is like the halfway mark, right? And basically we look at selling when it's up here and we look at buying when it's down here. Strategies. All right. It doesn't mean we're always just selling or always just buying, a spread. You're buying one and selling one, right? And that's kind of what we're doing with this one. But ultimately, the overall trade is the long calendar. So we want to be buying cheap premiums. And if you guys really want to know how this is figured out, actually, Toss has some script for the last 52 weeks. If you guys reach out, I can give you the script where it gives you the last, I think it's the last it is the last 6 months. So basically right in there somewhere. Actually, we're in the 7th month, so it's going to throw it in right around there. It'll draw the line there and then kind of take this data here. All right. But anyway, with this, what we have here, we've got the high, the low, and the current. What you do is you take the current implied volatility minus the low, right? And then you take that sum and divide it by the full range. High minus the low. So really all we're trying to do is determine where the current is in relation to the overall picture here. And if we do this, we basically, what were my numbers on here? 51. So current is 27 minus 25. Take that sum and divide it by 51 minus, 51 minus 25. So we got 2 divided by 26, right? So that equals about a 7.5%. Let's 7.69%. All right. So that's low. I usually say, this is the 50 mark. So that's your above water, below water. You're buying below, you're selling above. I also have strategies for right there in between, or if you really are unsure where volatility is going to go. We even have strategies to offset that volatility so you don't have to worry about it. Okay. But in this case, with volatility this low, I want to take advantage of it. Kind of like what we talked about last week in the calendar. There was some skew there too that we were able to take advantage of. So really low implied volatility. So I've got to be thinking I am looking to buy these options because I know that that 27 is pretty cheap. Okay. Now, I also talked about we have a longer term bearish assumption here, right? So in longer term, I have to buy more time. I have to go further out in time. So with the diagonal, something to note here is we are doing separate months. I'm going to go pretty far out here to buy, and then I want to take advantage of these nearer durations ones with the sell. So if I am buying here and I'm selling here, I need to make sure that there is not a major difference between these two. So I would say that it needs to be less than 3% difference. Okay. Anytime you're doing a calendar or a diagonal, and especially I only teach the long and the long calendar and the long diagonal. I will never teach a short diagonal and a short calendar. It does not make sense to me. It's not logical. So I will only go with that. So we want less than 3% difference. Why? Because volatility determines our premiums, right? And if I'm buying out here and this is like 5 times or 5 percentage points higher, that means that these premiums are really expensive, right? We could say these are expensive and these are cheap. So I'm buying expensive and I'm selling cheap because of that big difference. So I want less than 3% difference. Volatility affects further duration options more, okay? That's why it usually goes up. Now, last week we saw that example where volatility was almost, I think it was even higher in the front month than in the back month. Now, you ever see that? That means you know you're selling expensive and buying cheap, right? So usually you will see this paradigm where it increases. You want to make sure it's less than 3% increase, all right? If it's basically 3 to 5%, you're kind of like in a yellow area, a yellow light where it's a little bit sketchy on that. So try and stay away from that. Just want to make sure. I went the wrong way. Tried to scroll through, make sure I got everybody's comments so far. All right, so we've got the volatility. Why are you shaky on me? All right, so we want to make sure a situation like this, when they are close, that means we can take advantage of the premiums in here. And I threw this in here, the Baidu. So Baidu, if we look at the August 42, and I wanted to look at the October, this is one of those examples where we can see volatility decreasing. All right. So in a situation like this, now it didn't really set up the charts for me and everything else, but you can see with this, that would be a situation if there's no earnings, like you don't want, one of the first things you ever see this happen, the first red light that goes off is, are there earnings there? Okay. Because binary events, things that are unknown, will drive volatility in and around that month higher. So if there is no if there's no binary event there, then that's a great situation to have. All right, where volatility decreases because I'm buying out here and I'm selling in here. So I'm selling expensive, buying cheap. EA Sports is one where we can see, I'm trying to draw my line across here. Augie Sepp, I guess, is another one. See how big of a difference this is? Now, this is also decreasing there, right? I got to worry about a binary event. That binary event, though, is right there. So in a situation like this, that would be something that you could look to take advantage of. I'll probably stay away from it because it's still going to be within, I'll still be in this trade during the earnings, which I don't really want to set up for a long-term trade based on an earnings. I don't know, right? I don't want to trade long duration when I got an earnings right around the corner that could change everything. So stay away from that as well. All right. So if it goes down, you're probably looking at a pretty good situation. Like we talked about last week, we had a perfect situation there. But make sure that red light goes off, the warning light, hey, we could be trading this around earnings. So ultimately, we've determined that our options are cheap and that we have that volatility. I don't know why this don't want to pull up. We're buying that option, but we're also getting that hedge, right? Because we are getting that volatility paid for. We're kind of selling out of that volatility, and we're also getting rid of some of this theta decay that's going to be happening, right? That we want to avoid. So we're trying to avoid all of the negative things that could happen to us in a situation where we're buying options, because we want to buy it where volatility is low. We know it's probably not going to go much lower, and that therefore the probabilities are that volatility is going to start creeping higher. One thing we have to know is that thief. That we're going to try and pay off most of this, but that thief in the night could come and steal our premiums. I put this in the wrong place because this is, Citi. This was the example of last week where we had the volatility was very close. I actually thought it was almost exact, but you can see it's slightly down. All right. So that was a situation we did for the calendar last week where we were buying further out and selling nearer duration. So we were getting that paradigm where volatility was skewed. All right. And we were able to take advantage of that. Another thing to note, volatility affects as volatility increases and decreases, it usually affects further duration options more. Okay. And you can see that show up on the Vega coefficient. I don't have it on that one though. So look how we set that trade up last week. I wanted to just talk about the volatility differences. So right when I was saying, we got that volatility lower, so I was buying cheap, selling expensive volatility, and we did these strikes here. Well, the underlying was trading 68.22, and then it's gotten a dollar move down. But what I want you guys to really notice here that's really helping this strategy out is look what happened to the volatility in the months that I was trading. This volatility went down and this volatility went up. So I sold those and I bought these. What do you think happened to that strategy? Right? It's the long put calendar. Right? Bought these, sold those, long put calendar, volatility went down, volatility increased. The underlying did go down a little bit. So that's helping me out also. But the thing I really want you to take away from here is the fact, it's only $1 winner, so it's not a major move, but this I would say is the major winner. I got a increase of 1% here and a decrease of 1% there. So my premiums adjusted just based on that. No, this was making money. So I have a long put calendar on. So if I'm selling these premiums and that volatility goes down, remember, volatility goes down, the premiums come out. And as volatility goes up, premiums get jacked up. So the ones I bought, those premiums started increasing and the volatility started going down in the ones that I sold. So that started helping me out. Yes, I did get a bit of the directionality correct, but I don't want to talk about that as much as this volatility shifted back to normal, right? Where volatility increases. So that whole thing helped me out with that trade. Does that make sense, John? So if earnings are around the corner and if the near month implied volatility is higher than the further month, the diagonal would probably get butchered by volatility collapse. No, actually it probably would. Well, the further duration options being affected more, yes and no. Usually that binary event, though, is going to be really pumped full of some volatility. So that volatility will normalize. The other back month volatility will come out as well, but probably not as much as that front month, only because there's a binary event there. All right. That binary event is shifting the way we looked about the volatility. Does that make sense? And I wouldn't do this for an earnings. Like say, for instance, Citigroup had an earnings around the corner. I wouldn't be doing this 5-10 days in advance. As a matter of fact, I wouldn't do a diagonal for an earnings trade, really. I just don't have that much conviction, to be honest. So that's why I would avoid that. I'd rather see what happens and then trade it afterwards like I did with the Citi trade. This Citi trade we put on right after the earnings and was still able to take advantage of that shift in that theta. All right. So the next thing we need to worry about is the thief. And it's just theta. If you want to remember theta, it's the thief in the night that comes and steals your premiums. So if we are looking at it, we can see theta on the calls and on the puts is always negative. Why do you think it's always negative? It's a thief for one, but it's negative on both sides. It's the advancement of time, right? You can't go back in time. Theta is the thief that comes and steals your premium every single night. Well, we can't go back in time, so he's never giving them back. All right. That's why theta is always negative. And what we can see is further out here, we are only losing about 15, 16 cents a day, every day that goes by on the calls, and 15, 16 cents on the puts. Now let's fast forward. You go forward about 30 days, right? From 85 to 57. These thetas only increase by about 2 to 3 cents. Now we fast forward another 30 days. Look what happens to this theta. A much bigger multiple increase, right? That's a pretty big jump. Basically, we're talking 6-7 cents versus 2 in the last 30 days. And then these next 20 days, it doubles. All right? So theta is not linear. It's not a dollar, or penny, a penny, penny, however you want to think of it. It's basically $1, and then it's $1.50, then it's $2, then it's $3. All right, so it starts really ramping up. It starts falling off a cliff, really. So remember when I was talking about that buy zone. You want to buy, basically, I got a little bit carried away. It's probably, inside of there. 45 days is kind of my deal here. 45 days. That is your buy zone, sell zone. Got thrown off. I hit my mic. Sell zone. Yes, it's getting worse, Trevor. Sell zone. Why? Because look what happens to these premiums. They drop 50%. Basically 35 days to 7 days. So in those 20 some odd days, we get a massive drop in our premiums. Whereas out here, and the further you go out, you'll see it kind of levels off. So we want to buy out here where we have that limited theta decay and sell in here where that theta is going bonkers, right? Because I want to sell. Those premiums go down faster than the ones I'm buying. I'm retaining value, okay? And we can see that show up in that chart, as well as over in the option montage, which we showed there. And with our particular trade, we can look at it. I'm going to just look at the put side because we're looking at a put diagonal. We can see theta inside of 29 days, 24 cents. This to here, I wouldn't want to get involved here because if I buy this option, right, if I buy these options, I can see what's going to happen in the next 20 days. It's really going to start increasing. But if I go out here outside 70 days, remember I said my sweet spot's outside that 70 days, the ones I buy for the next 30 days are not going to start eroding that much. The ones I'm selling in this August are going to start out losing 24 cents a night and then really ramp up. It's going to double in the next 20. It's going to be twice that much in the next 20 days. Okay. What was the numbers for the city before the drop? Actually, I think the banks were coming out with better than expected earnings. And one of the things I talked about in spotting the trade was I think some of the regional banks, not the Goldman Sachs, the JP Morgans, those guys are going to do good, the institutional ones, but the ones that are focusing on the retail are going to struggle. And the reason why is because I think interest rates are going to stay lower than what we were kind of anticipating about a month ago. I think we're seeing interest rates right in and around where we should probably be. I like the 30-year below basically 1.8. I'm thinking 1.918, and the 10-year easily below 1.5. Oh, I meant the option chain city. What was the numbers before the city drop? Do you want to see the prices before the city drop? Was this the prices before the city? This was the prices before the city drop. Right there. And I think I paid $1. I think it was $1.22 debit I did for this. Was my actual price on the trade. And it's literally trading right around $1.22. The dollar drop, how did the IV change? As it dropped, I'll just pull up a chart. I don't have all that memorized. I'm sorry, John. All right, so where do we put on this trade? I think it was we put on this trade right in and around, well, it was last week, so it was right here on the 15th. I think I put it on the next day. So we got the market moving. Volatility came out. That's where we saw that volatility coming out of that front month there. It helped me out. And here you can see the market actually did start. It's lower than where I put it on. I put it on at around, I think it was, what did I say, 88-ish or something. So I am slightly lower than where we were, but overall that volatility from when I put it on has come out. Did that answer your question on that drop? Volatility actually started coming out right there. It remained high as we started selling off. I don't think it really spiked on me though. At least not enough to make me worry about it. Does that make sense? All right. What's my next slide? Yeah, started shifting everything around here for you folks. Where are we at? Theta. Oh, I got the chart up. All right. So if we are going to be selling, I want to sell a put here and I want to buy out here to limit that theta decay and take advantage of the theta decay here. Okay. And the reason why is it'll help me pay off this put a little quicker. And I'll talk about that here in a second when I start breaking down this trade. All right. So we're looking at this. We've got our resistance. We've got our support. I believe this is the target right here. I'm looking for the market to come down and at least test this little area for this trade. So I want to do a longer duration, long put diagonal because I've got those volatility coefficients really tight. I can take advantage of a longer duration trade. And with the put diagonal, I can eliminate some of that theta decay that we're talking about. And so first, let's talk about delta because delta tells us the rate of change to an option. All right. So for every dollar move, so if you bought 100 XYZ, remember when I was talking about XYZ trading 100? Well, usually what people do is say, you know what? buy 100 of those, right? You're buying 100 of the underlying. Well, if I bought 100 of the underlying, that's 100 deltas, meaning for every dollar move higher, my position moves higher by $1. Every dollar move down, my position moves down by $1, okay? Now, if I buy a 50 delta, if I buy a 50 delta call and the underlying moves up by $1, my position moves up by 50 cents, okay? If I buy a negative 50 delta put, position underlying moves higher by $1, my position moves down by 50 cents, okay? Because it's a negative delta, right? Moves down by $1, my puts increase by that 50 cents because a negative move plus a negative delta makes it positive to the position. Still with me? All right, good. So delta tells you the rate of changes to our premium, but it is data. More importantly, it tells us, I told you earlier, it tells us our probabilities. All right, our probabilities. A 50 delta is a 50% probability of being 1 penny in the money at expiration. Right? It's not during the life. I hear a lot of people online saying it's during the life of the option. That's not true. It is to finish 1 penny in the money at expiration. Meaning if I was long a 50 delta call and the underlying, if I was long a 50 delta call, that means that call has a 50% chance of being 1 penny in the money. Okay. The probabilities of during the life of the option, it's 2 times the delta, all right? So if I add a 20 delta, that means during the life of the option, no matter how long this option is alive, during the life of that option, my 20 delta has a 40% probability of touch, right? So XYZ, $100. Let's just say the 125 call is a 20 delta, okay? That means during the life of this option, XYZ has a 40% chance of trading 125 even. You just see 125 printed, right? That's 2 times the delta. So if whenever you're setting up a strategy, you can do the math in your head, 2 times the delta, that's the probabilities of touch, not being in the money, all right? So with the long put diagonal, what we want to do is try and create a situation where this acts a lot like the underlying. So when I'm starting with the long in the money option at around an 84 delta, okay? That means for every dollar the underlying moves down, it's actually a negative 84 delta. For every dollar the underlying moves down, my position increases by 84, or my long put increases by 84 cents. And then this put here, don't know exactly the delta. It's probably going to be right between a 16 and a 25 delta, all right? But what we do with this put, that put we sell, it pays off all the extrinsic value, all the theta decay of my in the money option, because in the money options will generally carry the intrinsic value. Remember, that's the benefit. It has to be the retainer of that value of where the underlying is trading and where my in the money put is, plus some theta decay. All right. So selling this short out of the money put, which is all theta decay, that amount of money is what we're looking to cover our extrinsic cost of our further duration option. Okay, I'll show you how to do that here. It's pretty darn easy. Yes, you can go through a bunch of math, but we're going to do it real easy. Not sure why I threw this up here, but let's go through the trade again. Let's just say that I have a bearish assumption. I know Vega has very little difference between the options that I want to buy and the ones I want to sell, less than 3%. That's a green light. We're good to go. We know that we're not getting too much premium. So one thing about these puts, All right, in the money, you can see the gray line. In the money, options are the ones that are value, right? If I buy an in the money option, that has value, right? Because that means that I can sell it higher than where it currently is. And I have to be compensated for that. So if we look at this 530 put, we can see that the premiums are right around $37, and let's just call it $37.50. So we'll say the mid market here is $37.50. Okay. Now, if we take $37.50 and subtract it, let me just do my thing because I've got my brain trying to think of two different things, and I can tell I'm not going to be able to do this math. So 530 minus the 37.50. All right, 42 or $492. So we know that this number is much lower than this here. So there is extrinsic value in here. Another way to do it is if I know that this 530 put has to be the retainer of value to here, I know 530 to 509, let's just call it rounded off to 509. I know that's a difference of 21, right? To 509, where it's trading. The difference to 530, that's $21. So really, all this option is only worth $21. That other $16, the other $16.50 is theta decay. Now you can go through all this math and do all that, and I know probably I lost like half the people watching because I was doing all this math. Listen, folks, floor trader hack for you. When you're looking at in the money options, look at the corresponding option and it will tell you about how much premium is there. It's a ballpark. It's going to be off a little bit here and there, but rather than going through all the math, just glance over there and you can spot it. All right. So let's run through this trade real quick. We looked at I was looking at these 580 puts because they are the negative 84 delta, or as close to that 84 delta as I could, right? I want to start with that longer duration option where I can limit that theta decay. We can see the theta decay here is pretty low, and you can see the theta decay up here is almost 10 cents more a day. So that's what we're looking at. So I'm looking at buying these in the money options. What do? I just thought all right, what is that? $6. I mean, I'm rounding up, right? So I know that I need to pay off $6 from my 580 put. So I go down here and look for the $6 one. And of course it's slightly, oh wait, what did I do? The 485s. So I knew I needed to pay off at least, right around $6. This is the one that I ended up going with because now I know that if I sell this option, it's basically paying off the extrinsic value. Does that make sense? You see how that works? I mean, I could do the math here and figure out 480 to that. That's basically 71, right? So 71 minus the 76 is right around that $5-6, right? Okay, I can do all that math or just look over at the side. I'd rather just flip over there, floor trader hack. That's what we used to do on the floor. So much easier. And then look for that put to pay off that amount, right? So I sold this put near duration. It's going to decay rather quickly, even if the underlying doesn't move, right? So that front month option will pay off the extrinsic value of the option that I own, and I own it for what it's worth. Right? Over here, are you talking on the call side right now where I'm pointing? I'm looking over to the call side because the calls are out of the money, and out of the money options are all extrinsic value. There's no intrinsic value to an option that's out of the money, right? Because there's no benefit to owning an option that is out of the money, right? An option that's in the money, there's a benefit for it because there's an intrinsic value to it. All right. So I'm looking, rather than going through the math and saying 580, and that's pretty easy. 71, that's pretty easy. 71 minus 77. That basically is $6-ish, somewhere right in between. You know, I'm like ballparking. I don't have to have the exact amount, nor do I have to have the exact amount when I just flip over here and look at it. It's right around $6. So I look at least $6. Okay. So I went with that 485. Now, the next step in this strategy is to make sure, the reason why I have this calculator over here is got to be less than 75% the width. You're paying a debit for it. It's a long spread, but you don't want to pay more than 75% the width of this spread, folks. I mean, it's a higher risk strategy anyway, because you're putting out a lot of money. I mean, you got really good probabilities of success, but I don't want to have any of these headwinds with theta. I don't want to have my risk like supersede. As a matter of fact, I've seen it, folks, where people will set this up completely wrong, where they are buying really expensive back in that back month and selling really cheap. Well, that spread, I've seen it where they can lock in a loss. All right, meaning on this one I would be paying what I've got a $95 wide spread. I'm paying, and then I paid $100 for it. All right, I paid more than the width of the spread. You can do that. You can make that mistake with this strategy if you aren't following my guidelines. If you follow this guideline of less than 3%, it will never do that to you. Yes, it could go up to like 85%, but it won't be more than. The only time you're going to get more than is when you see that massive skew. All right. Are you trying to cover the cost of the long put with the short put? I'm trying to cover the extrinsic value. I'm trying to get rid of theta decay. Okay. And here's what it will look like on, your analyze tab. You can see basically where the underlying is currently trading. My break even is slightly higher than that. And you will have no risk to the upside if it goes above basically 700, but we're not going to wait that long. As a matter of fact, it's a 580 put, folks. That's basically at the 52-week high where we're buying that. So don't let it go there. Once it breaks the chart pattern, right? We talked about these types of candles, right? If this was looking for that bearish move, you are out above this setup wick, all right? If you have a lower risk tolerance and you got involved when it was confirmed, then you're out above there for a lower risk tolerant. Even if you're a higher risk tolerant, I would say that you're out. This would be your out, all right? You get another down move, this is your out, okay? So you kind of continue to roll that stop down. Now, here is a little bit tighter one, right? I still went with the 580s. That's at this time, it dropped down a little bit. But again, just looking over to the calls, we look to see, all right, it's right around that $6. I got to pay off $6 of extrinsic value in these options, all right? I go a little bit tighter. That's more than $6. I'm paying more than the extrinsic value of the option. I'm getting it cheap, right? Well, what happens when I look at this difference? Basically, the $69.10 versus the width of the spread, which is now only 90, all right? My spread before was $95 wide. Now I only got a $90 wide. So that increases that to above that 75%. So when you're doing this, you're really shooting for around the 84 delta. All right, how much do I got to pay off? And then, step 3, I guess this is number 3. You go to there. Step 1, right? Number 1, number 2, and then look to pay it off with number 3 step, right? This one does pay it off. Step 4 is a check or no check, and this is a no check. But very similar, just 1 or 2 spots away from that. All right, where do you get out? Whoops. Where do you get out? Anytime you're breaking above. I think on this one, I thought I had a chart there. That's why I wanted to flip to that one. I want to go to the chart. Where's my chart? All right, I'm going to have to, I'll just pull it up here. What am I looking at? Netflix. All right. So, you know, the candle actually even changed from when I started doing my screenshots here. And it looked to me like we were going to go below that 50-day simple moving average, which is really why I was looking for this with this trade. I'm still not concerned because I don't think that this is at the bottom of a move. I'm not going to do that. I am a little bit concerned about this 50-day simple moving average all of a sudden for this trade. So it'll be a game time decision tomorrow. But looking at playing this to the downside on this, if I were to implement this tomorrow, my out is above this previous day's wick. Okay. That's where I would look to go. Just continue to follow those tops down as you're getting your directional move. Don't forget to subscribe our channel. That's right. Thank you for reminding me, Patricia. Don't forget to subscribe. Make sure you guys hit that and get the notifications because like I said, I'm going to pop in here throughout the day, sometimes during the trading day. If I find a trade or spot a trade, I'm going to let you guys know about that. Or if I take off something during the day, I'm going to pop in there. So make sure you guys get notifications for that. To take advantage of when I'm going to pop on and talk about specific trades there. All right. So without further ado, then I'm going to throw this out to you guys. You guys, this is our offer for you today. I think Patricia threw it over there in the chat window. If you're watching this on tape delay, it'll be down there in the comments section too, I believe, but you can type this into the tape delay or just hit the comments section. That's probably a little bit easier. But with this, for $36, you guys get hours and hours of content. And I'm sure for $36, I will avoid a $36 mistake for you guys, all right? You'll pay $36, you'll probably avoid hundreds or thousands of dollars worth of mistakes on these tradings. So take advantage of that. Yes, I see it's thrown over there in the chat window. It'll bring you up to this page. It'll show you all this stuff, how you set up your trades, your trade window. You can also reach out to us. Don't forget, we got the script there for you for how to get that implied volatility percent for only the last 6 months. All right, options terminology, generating, trading with gamma. If you like gamma trading, shorter duration options, we'll show you how to trade with that. All of those things, support and resistance is great. And that's about it, folks. If you guys don't have any other questions, if you do, feel free. I'll stick around here for a moment. If you want me to go over a couple of trades that you think of real quick, throw it out there. Otherwise, make sure you click on that link or, you know, you can pause and punch this into your URL if you want. I appreciate you guys all for sticking around. I like the back and forth. Love you guys in the comments. It keeps this fresh. So I appreciate that. I want to hear from you guys because you guys, I want you guys to drive the content. I believe you guys will learn more if you guys are driving the content. So throw me some curveballs, man. Sling it at me. I'm there for you. All right. Try and string me up. I don't care. So we would pay around $7,000 for one contract for the diagonal. On my diagonal, we would, I don't know what I don't know what I had to put up for that diagonal in buying power for that. I'll try and check real quick, see what it would do. I should know this and I can't think of it right off. I'm having a brain cramp. So it's literally, I just pulled this up on my platform and it defaulted to 122. That's exactly a scratch for me on this. So if you are doing this, no, you're only going to have to pay, $122 for it. I don't know why I was having a brain cramp on that. Are you talking about with margin? Oh, step 4, 75% step 4. Wait, why did you show that? Oh, yes. John, you're right. Jeff's answering your question. Why did I show the one with the 85 and the 90? Because the wider spread fit my rule of I paid less than 75% the width of the spread. Meaning, in the example we were showing with where's my, are you on it? The debit, here, I'll go back to it. Give me a second. All right, so this is the one that was a little bit tighter. Remember, this is the one where I easily paid off the extrinsic value, but I paid $69 on a $90 wide spread. That made, I paid the $69 debit is more than 75% the width of the spread, right? And in the one that I did earlier, where we were looking at this one, I'm paying $70, so I'm paying more, right? But I've got a wider spread. It's $95 now wide. So I'm paying $70 on $95. That's only 74%. So I'm paying less. I have a higher probability of success, or not probably, I'm sorry, I didn't mean to say that. I have a higher profit potential, right? And that's what I'm trying to get there. And I'm trying to keep you guys, I'm trying to avoid you guys getting into that situation where you pay too much versus the spread. I want you guys to make sure you're thinking about that, because like I said, I've seen it where somebody buys this option and sells an option in here, and basically the spread is $50 and they're paying $55. Don't do that. You locked in a loss. All right. How do you determine which option strategy to apply when there are so many choices and the bullish bearish strategies? I can't put my finger on it yet. Thank you. I appreciate your question. So I try and go through this with these webinars, and I go into it with the idea that I do know what strategy I'm going to use for that particular one. But I try to give you guys some rules and guidelines to think about logically for yourselves in order to determine what strategy to do. For instance, if I had a longer term bearish assumption on this and that volatility skew was all flipped out of whack, right, where I'd be selling really cheap in the front month and paying a lot in the back month, well, then that wouldn't work for this strategy. So I would look to doing maybe a long put spread in that further duration option, right, because of that skew. I'll try and pay off some of that value that way intra within that expiration cycle. Does that make sense? If there's a big skew, then I still have that longer duration assumption, then I'd probably go to just a long put spread in this month. Okay. And the other thing you can do, the beauty in this is with all this theta decay that we're getting here, once this option expires worthless, or maybe it's worth 10 cents, I'm going to get out of it. All right. I'm going to cover that trade, leave on this long put out here, and try and ride it out. Okay. Another thing you could do is open up these SEP contracts and look to sell another option. Make sure, though, when you're selling that option, you're not locking in a loss, right? I've already paid $70 here. I would not want to sell another put and have it be tighter than that, okay? Only way I would do it is if I could go make that spread wider and lower the cost basis, okay? Any other questions there? I know I kept you guys around a little bit longer. I do appreciate you guys sticking. I want to make sure everybody is clear before we move on. So I'll stay around for as long as you guys want. Like I said, here is that link. It's over in the questions box or over in the comments box. So take advantage of that. And without further ado, all I got to say is make sure you guys hit the subscribe button, get the notifications. Also, comment over the side. I will reach back around for you guys to make sure anybody watching this later on today, next week, next year, that you're clear of concept. So we get notifications on that. I get notifications from you. You get notifications from me. And finally, if you can't smash that, take that.